Volatility and an FOMC meeting. Crazy day. I mentioned earlier that I had some puts that I basically closed out. Squeaked out a profit. Should have closed them out much earlier, but thank God I had some trailing stops set on. I should have set them much sooner. Anyways, my plan is on Thursday, tomorrow, Friday, to start entering the majority of my opex position for GME. I feel pretty confident in the the Bed Bath and Beyond, aka Bobby position that I've got established right now. I already have my volatility position, which I've had for quite some time on GME, and overpaid. I will add for that too, but that's a Justin problem. Very curious to see what's going to happen with price action tomorrow. Very curious to see what's going to happen with price action on Friday. And let me just be very clear. One of the things that I don't think I'm going to get right, which basically is a fancy way of saying, which means that I got it wrong, is I had always assumed, or one of my big assumptions was, these big guys, sitting on, $100+ million of put positions going down. These puts were going to print, and that was my assumption too. But earlier today on PiFi Stream was noted that this might be due to mark long FTDs. Also of interesting note, and this is where, please, check out PiFi Stream, because I can't talk about this accurately, but this is one of those things mentally, I'm very, very clued into this. It's trying to understand the market mechanics of GME FTDs, because it seems like, again, this is just me trying to regurgitate this, so please go to the source, that you are starting to see FTD pressure pile up on GME versus piling up on XRT or on an ETF. If FTDs get to the amount where GME is placed on a reg show, that will create some sparks. But in any event, for the salient points, though, is I definitely think it makes sense for myself to go into Thursday and Friday, establishing the majority of my OPEX position. Lastly, I do have a small put position that expires not this Friday, but a week from this Friday. I'm going to keep that open just in case, it goes to the downside, because I do not know what's going to happen between now and then, but I like to have all my bases covered.
Yeah, no matter what, I will be fully positioned by Thursday and Friday. So average costing over the next few days, basically just buying every 30, 40 minutes, different calls. If you want to know exactly what strikes that we were planning to open. The other thing I would note is there is a chance that they start to cover early. And if that happens, it is completely fine. We saw this in November.
Yeah, so I think just the interesting thing is that, like, both you and I, we both have, our volatility positions as set up on that front. And for Bobby, it's much easier because Bobby's just been, floating around at a very attractive entry price. For a GME, like, here's the thing, right? I see there's two tranches of options I want to buy. I want to say tranches. I'm not saying I'm going to buy like two particular contracts, but this is conceptually how I'm thinking about it. Whatever at the money is, and like, the thing is, the at the money is going to change. Obviously, in this case, I want the at the money to be as cheap as it possibly can be, but I have no clue what's going to happen with the price action, so I just have to bite the bullet and do that. But then I would have maybe, let's say, something maybe 30 to 70 bucks out of the money at that time that would also kind of target. And then, as you, Josh, allude to, when you start going and you dollar cost out, or you kind of say, okay, well, listen, if I want to establish 33% of my position on Thursday, 33% on Friday, and then maybe 33% on Tuesday or whatever, so be it. And the worst case scenario is if it does start to run, we just simply buy at the money options as it runs up. They're going to be expensive, but whatever. As long as you have your volatility play, you'll be hedged there. Also, Josh, the other thing too that I really want to see if I can get done is I'm very keen to see if I can find a way to exercise at least my at the money options, because I definitely want to take delivery of shares. And kind of honestly, I'm keen to, use or take a page from the market maker's book and say, oh, no. Go ahead. Just here's the money. Send me the shares. So I can use my volatility proceeds to exercise at the money call options, or out of the money, but then options that become in the money. I'm paying attention to that. I'll just say it like that.
With regards to the overall market, we saw a massive jump after the FOMC. I did actually write some puts on the NASDAQ. Check out our Twitter for information on that. And no matter what, I'm also going to be closing those out over the next few days, strictly because of I want as much capital as humanly possible going into this OPEX cycle. So I want to have all my free capital, and I'm actually going to go on margin just because I'm going to be closing out these positions next week, no matter what. And I'll have stop losses on everything, and I know my risk to reward with everything before I actually enter it. And that's vital when you're going into these positions, because it allows you to calculate exactly how much risk that you can actually take, and managing risk is one of the most important things. How do you actually sell going? Let's say the cycle does work perfectly. Every single breakout, basically, like the stock will run, and then we'll kind of trail for a few minutes maybe, and then it will break out again. That is when you want to start to sell these volatility positions. And I would put limit orders, kind of going them much further out of the bid ask that they are asking for, just because that is when IV starts to spike. And that is why I feel confident that these IV positions could print so hard, just because we see this countless times on GME, especially during these cycles. That is what I'm personally going to be doing, sitting at my computer pretty much all day, every day next week, selling these contracts at every single breakout, slowly building, trying to just hit every single breakout, betting off the volatility.
The other thing to know, you have already established your Bobby position, right?
A super small percentage of it. I mean, right
Yeah.
now the contracts. I mean, again, with my BBBY position, I honestly don't think it's going to run. I mean, right now everything that I'm buying on BBY, I'm writing off. I'm just saying, it's probably not going to
Okay.
happen. But if it because I'm going so ridiculously far out of the money because I'm strictly playing as an IV play. But if it does run though, it's going to be literally like a 5,000% return because if it does run, IV is going to spike because right now the option makers are pricing the probability of a run so ridiculously low that
Yeah.
is why it provides so much ridiculously opportunity. I don't think it's going to run like the previous cycles just because what last time we did run, we saw massive dumps of shares from these institutions. So maybe we run to $15-20, but under that circumstance, if that happens in a week long span, IV is going to get up to 60-70% intraday, probably much further than that. And I'm being
Yeah.
pretty conservative there. And if you just look at a simple option calculator, though, the optionality on those, if you get super far out of the money, go give yourself time on these. But if you go super far out of the money, they just explode in value. So I'm writing everything off that I put in, but I want to position at least maybe at like 1,000 contracts because they're so cheap. Or I don't know, like if they're 10 cents, I call it whatever they are. I want to get a few hundred of these contracts at least, write everything off. But if it does happen, just know that's going to be the most percentage gain I've ever seen.
Yeah, and I want to say too that Python mentioned, I haven't pulled it up on Market Chameleon, but there's a very strong gamma ramp on the upside on the Bobby option chain that exists. So if you see it run up to, let's say, like 15 or 20, you get this thing where you get, the positive feedback loop. So, and then if FOMO starts coming in too, we'll see where that goes. But that being said, you also have a much more liquid stock and familiar things. So, it's, pluses and minuses all the way around. So yeah, no, interesting times. But yeah, curious to see
I,
how
I
next week's going to play out.
I
Excited.
also don't know what's going to happen with the overall market. Either way, I think there'll be a Gini run. But if the Fed just came out into the 75 basis point hike and they are forecasting very, very hawkishly, I think the market today was exploding. But in either way, I do think that could put some downward pressure on the market. And what happens to GME in that situation, I personally don't know. I have zero edge there. I still think we're going to see a run, but if we're crashing massively, that could suppress the run just because of all these sell-offs going through passive flows.